Another company that we have a high conviction position in is a company called Close the Loop Group. They're about 170 mil market cap business. And this is an interesting business. They're basically a global provider of circular economy solutions. So they have two divisions. They have a division called Resource Recovery, and that's essentially their growth engine. It's about 70% of their revenues. And what it does is it's repurposing of electrical items for OEMs. So if you think about the likes of Hewlett Packard, Dell, Microsoft, and so on. They take back laptops, printers, gaming consoles, and they recycle printer cartridges, and they refurbish them, upgrade them, and then sell them back into the market and share the revenue with the OEM. And then they also have a packaging division, and it's essentially a manufacturing of reusable packaging products by collecting soft plastics and then doing recycling and sustainable packaging solutions. That's about 30% of the revenue. We believe that's will become smaller and smaller part of the business as that resource recovery continues to grow. Now, CLG is a ESG economy beneficiary. They've put a lot of significant R&D and IP into some of the solutions that they have for the waste. For example, the toners that they take out of those print cartridges, they turn that into what's called Toner Plus, and that's an additive for road asphalt, and it really adds longevity to asphalt. And they've got a contract with Downer EDI in Australia, and they're rolling that out. There's really good demand. We've seen demand for many industries for life cycle management of products, electronics industry, data centers, servers need to be recycled, print, makeup, batteries, and so on. And, more and more companies need to look at the environmental footprint that they leave around, and it's really important. And they look for trusted partners such as CLG. Now, as we mentioned, the board and the management team own 45% of the company, so they're very aligned with us. In fact, last year they bought some more shares at 30 cents. They've given guidance, which they have upgraded actually at the February half-year result, sorry, of revenue over $200 million, EBITDA of $46 million, and an NPAT of $26 million. Very, very strong cash generative business. They've got about 25 mil of net debt, and we think that will turn into net cash over the next 6 to 9 months. So this is a significant business generating significant profits. In fact, its net tangible assets is 50 cents. It's trading at about 32 cents. We think it's a very, very cheap business with an attractive valuation, an FY24 P of 7 times, EV/EBITDA of 4 times. We think it's worth double. And I think the market will want to see organic growth, potential M&A as well, and refinancing of its debt onto a cheaper debt provider will be all catalyst in the next 6 months to re-rate the stock.